Hello, everyone. Happy Friday. Thanks for joining us on this Lunch and Learn. We are excited to start a series of due diligence and going in depth about the things that are happening in the market right now with commercial real estate specifically. Later on, March 22nd, we're going to do another Lunch and Learn. This one is not our normal Friday Lunch and Learn once a month. This is a special one. We're going to have a panelist discussion with multiple sectors of commercial real estate presenting and talking on what they're seeing in the market. So we would love it if you could join us on that. The website to register is tempofunding.com/REI. So hope you can make it. But without further ado, I'm going to introduce Mike. We also call him Misha because we have another Mike on our team. But he is the director of asset management. He helps with a lot of research and he's really good at what he does. He's got a lot of experience and I'll let him cover that. So without further ado, Misha, go ahead.
Yeah, good afternoon, actually, already, everybody, and thanks for joining. Christopher, David, Gerald, Jay, B. Dwake, thank you so much for being our guest today. It's our pleasure to talk about the commercial real estate, and I'll try to be concise, I'll try to be understandable, I'll try to be easy, and let me briefly cover what we're going to be talking about today. Say a few words about myself and quickly jump into the topic of this conversation. So we're going to talk generally about strategic commercial real estate insights that are happening in the market of the United States. Precisely, we're going to focus on some opportunities in multifamily market. We're going to talk about the projects that need an additional capital infusion, additional financing. We're going to talk why do they need it. We're going to talk about why do they need it. We're going to talk how can we help them. And what is the value of doing this step? So at the end of this seminar, I hope you will be able to more clear understand the underwriting process in mass debt financing. How do we do that? Why do we need these things? And if you have any questions, I'm more than happy to cover those as well. So this is a little legal disclaimer. You can read it. Take a couple seconds, please. That's important. And take a screenshot
Basically,
if you need.
basically it says this is for educational purposes only. This is not a solicitation.
Yeah.
And please consult a legal professional or CPA before you make any investment decisions.
Thank you so much, Dan. So a few words about myself. Originally, I am from Russia. My Jewish family lived a little bit in Israel. Then we moved to the United States in 2017. I got my MBA from the University of Chicago Booth School of Business. That was super interesting. I was, very involved into this life. I have a CCIM designation, which is very well known in commercial real estate. I'm serving as the CCIM Miami chapter board. Originally, being from Russia and Israel, we live right now in Miami, in Boca Raton. I have a family of 3 kids. I have 2 daughters and a son. Speaking about my experience, I was the head of business development for Cushman & Wakefield for the whole post-Soviet Union space. And being a director of business development, I was involved in many things like advisory, project management, valuations, tenant representations, retail, highest and best use, IPOs, you name it. We've been doing all those things like every day. So, and as my little hobby, I play the guitar just to be well balanced in work and life. And that reminds me of the importance of balance, compassion, and resilience. So if any one of you has the same hobby, ping me, we'll play together.
Misha,
Okay,
can you explain what CCIM is?
CCIM, it's a designation for commercial real estate, which consists of a huge community of members all across the world. Actually, it has its own institute that gives an education which is pretty similar to bachelor's degree that people say. You got to do 4 courses about underwriting, financial side, marketing. You got to hold a comprehensive exam that lasts like about 6 hours. You got to have about $40 million of portfolio behind you, deals closed, to be indirect participant in all this stuff. And since 2018, I think I've been holding this designation. So
And what does the designation stand for?
You mean how do you?
Commercial Certified Investment Management?
Yeah.
Okay.
Yeah. CCIM
That's
is
what I was
exactly what
wondering.
this is.
Okay.
Sure. Okay, let me quickly jump into the topic, what are we going to be talking about today. We're going to talk a little bit about the sources of capital in real estate. We're going to talk about the value creation process in multifamily. It's a very well-known terminology, value add. We're going to speak about key players and their responsibilities. We're going to talk about valuation and risk assessment, and what can we do as capital partners to mitigate this risk. Generally, we're going to be talking about the mezz debt. What is that? Why the ongoing real estate might need it, and what can we do about it? First of all, let me briefly speak about the nature of capital in real estate. It's pretty common for every asset class, I would say. But still, in order to put some foundation to our conversation, let me briefly guide you through this. We have generally 4 types of debt over here. Of course, each of them has some multiple subdivisions, I'd say. But anyway, we have senior debt, we have mezz debt, we have 2 types of equity, preferred equity and common equity. So speaking from the perspective of a borrower, let it be a sponsor who's about to purchase a multifamily project, the senior debt is the cheapest one. It's the base. You see on the top, you can see like the word base. It's the base price. And the mezz debt is kind of twice more expensive. The pref equity is normally 1.5 times more expensive than the base. And the common equity is the most expensive one. Why is that so? Well, the senior debt normally is the cheapest, but that requires you to pledge all the property as a collateral. It has a lot of requirements. They're going to get their money first should anything go sideways. If the property is sold right away, the senior debt is the first one that is going to be paid. Then, in this particular example, we see the mezz debt, the same stuff. It's a little cheaper than the common equity, but it's more expensive than the senior debt. You might need it, you might not need that, but normally the project always have the pref equity and common equity in place. They are more expensive, so normally the sponsor takes less of those. And the ratio of senior debt towards everything else is normally like 70-30 because your loan to value is 70%. That's the borrower, the senior debt lender would require from you. So this is the kind of big picture. And normally all the projects, they operate on this basis. When the sponsor wants to purchase something for, let's say, $100 million, he gets the 70 million from the senior debt, and then everything else is covered from all those 3 other sources over here. Again, not every project is designed like that. This is just a big picture so that you understand that all that exists in there. And as you can see, the risk reward over here, common equity is the most risky, but it's most expensive. Pref is a little less, mezz is a little less, senior debt is the least. So if I would be a borrower, I would get the most of my senior debt. It's the cheapest one, but I have to comply with some covenants. I cannot take 100% of that. So I need to have other sources of capital available to me. Here in this picture, there are a lot of words here, just explaining what I just told you about the differences of common equity, preferred equity, mezz debt, and senior debt. Lower risk, low reward, high risk, high reward. Low priority and high priority. I'm meaning that I need more of senior debt as a borrower and less common equity. You can pretty much see what it says over here, and I covered all that. So let's jump into the next one. So let's look at a typical project capital structure, and let's use an example when we purchase a property of 120 million with LTV of 70% and both pref and common equity in place. In this case, the project would have 84 million of senior debt, 23 million of pref equity, and 13 million of common equity. Reasonable, nice, plain vanilla, good projects. And that what normally was standard picture for the project acquired during, let's say, 2019 to 2022. Why? Because everything was good. The markets were growing. The multifamily business was booming. Everything was recovering after COVID. Huge demand. We've seen prices $4 per square feet, $5 per square feet per unit per month. So huge numbers, especially here in Miami, let's say. Now it's all not the case. And generally speaking, what happened during the last year and a half, as you know, everybody, the Fed, they raised their interest rate. And what happened is that a lot of projects that were about to refinance themselves, now they cannot afford it because it's expensive and they don't have any chance to comply with the covenants like LTV or like the CR, debt service coverage ratio, which means your monthly payment for your debt, I apologize, your monthly payment for the debt is supposed to be a certain ratio of your NOI. And they just cannot do that stuff. Give me a second. So what happens is they require for the mass debt. They require and they say, hey, would you please give us more money because the project is struggling. We got to need more financing over here because we need to still do the renovation. We need still to comply with the covenants. We still need to pay the mortgage. We still need to pay the pref equity, their interest. And as of now, we don't have enough money. The money are expensive. We could not refinance, or we broke some covenants and the banks is getting the possession, or they're getting under cash management. So the projects are struggling, and they're going to struggle more and more and more during 2024. That's what we're going to see, because there is another problem of maturity cliff, as we say, because a lot of loans are maturing right now, and they will have to buy an expensive rate cap, or they will have to borrow money using the existing rate, which is like extremely, extremely expensive these days. And now the question arises, if a project is requiring more financing, mass debt financing, is there enough value in the project to cover this mass debt? Is the project good enough to repay everything to everybody right now, let's say, or in 6 months? And what does it need to be able to? So in this particular case, let's think about it from a different perspective, I would say. We need to choose the right projects in order to finance them with debt, with mass debt. Again, where we are, just a short recap. The multifamily industry is suffering from a huge Fed reserve rate increase. And that's why a lot of projects are suffering. Some of them were bought very expensive. Some of them are in the wrong location. Some of them should suffer because that's the way they originated. An opportunity is there right now is to find the good projects with good sponsors in good locations that are suffering purely to financial reasons, to financial stress that they're going through right now. And that's an opportunity where you can inject there some money and you can get a lot of return on that, controlling all the other risks on here. So when we select the right projects to be an object for mass debt financing, we got to look at market and economics. What is it going there right now? We got to look at the property and the sponsor. Is it well as a real estate? Is it a good sponsor, reliable, reachable? It has a lot of experience. We got to run through a lot of due diligence, looking at legal, structural, financial, property inspections, visiting all those things. And we got to think, how can we deploy money having the risk mitigation in place? And here we jump into the question, what is the value? What is the value creation process in multifamily? Because a lot of people say multifamily, add value, but we need to understand purely what I was talking about over here. So let's get through the process real quick. I'm not going to go in details too much, but I want you to understand how does it work. I mean, majority of you pretty much do, but still. First of all, when you look at the project, you got to understand how was that bought? What's the cost basis? Was it bought at a good valuation, or was it overpriced? What is the financial situation right now in terms of their existing interest rates? Is there any assumability in their loans? What is the rate cap? Is it in place? In what conditions is it right now? Was it renovated a little bit, or it's like, never started? Some projects have a very poor reputation. You can do whatever you need to do there, but they're still in a bad area with bad history. You cannot overcome that. You need to understand the demographics where the project is right now. I mean, the median household income, the median house value. You got to look at the crime rate. You got to look at schools. You got to look at jobs around. Is it well located or not? Because if not, if someone bought it some time ago just to speculate it on the growing market, that's not the case. You cannot inject any of your money in there. So fundamentally, the project is supposed to be good enough, bought at a proper price with a good financial costs, and then we might continue thinking about it. Because if at this stage it didn't go through the filter, you just quit it. We got to improve them as a sponsor, as a person who's responsible for that. And there is a cost side to that and a revenue side. Both sides are equally important over here. Sometimes you got to understand, what is the construction cost? Is it not overpriced? Does the sponsor have an ability to control those costs? What about the material supply? Do they have enough supplies in place? Because, for example, after COVID hit us, you remember that a lot of supply chains were broken, and many sponsors suffered just waiting for materials, so they couldn't complete the renovation. And as a result, their revenue side suffered a lot because they could not increase their rents as they were thinking they could. So the labor cost, what's going on in there? Is labor available in the area? Can they hire enough people? Labor availability. What's about management? Do they have a good property management in place? Who is managing the construction process? Do they have an ability? Do they have systems in place? Do they have reporting systems in place? What is the financial cost right now for them to do that? Because they might still borrow a little more money to do that. Insurance. As you know, a bunch of projects suffered on insurance increase. Like we saw the cases that insurance jumped from 300% to 400%, especially in the natural disaster areas. David, I can see you raise your hand, buddy. You want to tell something? Pretty much, I don't.
We can do questions at the end. It's okay.
Yeah, okay. So the revenue side, the revenue side is super important as well in this case, because when you do the add value, you put some cost side, you improve it, you put the new cabinet, new vinyl floor, new ceiling, you paint it, you put the washer and dry inside, you do the exterior work, and then as a result, you want to raise your rents. Normally, when you raise your rents, your occupancy might go a little lower because people are not willing to pay this much. It takes some time to stabilize it and to acquire a proper tenant profile. So can you get some additional revenue over there? Do the tenants are running away from you, or they're good and your retention rate is high? You don't have to fight for any other client. Is your property management in place? Can you control it? Can they call them and say, hey, I don't see enough rentals, do something over here? Do they control demand creation? Are they good in apartments.com? What's going on with their Google reviews? So all that is crucial to create the value, because the cheaper you buy it, the more space for improvement for the value you have, and more flexible you are in case the selling price is suffering as well and goes a little down. And that's fine because you bought it right. You still have improvements in place. And even if the end price is fluctuating a little bit, you're still good. You have a lot of forgiveness of your errors over here. We got to analyze the market conditions, of course, what's going on with interest rates, political stability, trade wars, region and its economics, etc. So if there are any particular risk associated to this with this project. So when you look at the project, you got to understand that it's well designed and it has enough space for value creation, and it has right costs, and it has right revenue assumptions, occupancy, additional revenue, everything is in place. And then you can say, okay, with certain probability, most likely they will get there. Okay, will they or will they not? It all depends. And on the next slide, I kind of want to talk about the stages of the project and who are the key players who might drive the project forward. Normally, when you purchase something, you got a strong stage of growth where you do the renovations, you change your tenants, you increase your rates, your occupancy goes a little down, then it goes a little up, and everything is very vulnerable at this point. Any mistake in time, they didn't complete the renovation in time. Any mistake in rental rates, so they couldn't raise it enough to cover the assumptions, the project might suffer. What precisely happens right now in the project, especially at this growth stage, that's where the financial shock hit the multifamily. Not only them, of course, every real estate asset class, but we're talking about this one precisely. And that was the financial cost, and not enough ability to get refinanced, breaking of the covenants, insurance, significant increase. And now the projects are suffering over here, which creates more opportunities for lenders, for investors, for capital partners like Tempo. Because if the project is good and it went through all this cycle and we see that all components are in place, so we believe it has enough potential to be one of the projects where money could be deployed. If the project is at the stabilization phase, I mean, it's stabilized. To whatever extent the prices are high or not, the rents are as projected or not, it doesn't matter that much because they can gradually increase them, keeping the occupancy at a certain level, which is like a salvation for many projects right now. But the key players, who drives all that? Who makes it all really work? Who creates the demand? Who is in charge in the value add process, controlling the contractors, supply chain, speaking about work with the property management, all things that you saw. I mean, you can see by the size of the circles who is the most important partner, person over here. Actually, I can extend a little bit and you can see that's the sponsor. The sponsor is the person who really drives the projects. He's in charge with working with the brokers, with supply, with purchase, with sales, with improvements, with property management, construction, investors, and everything else. Oops. How do I go back? Yeah. So the bank is the next very important player because the banks control your senior debt and they can, control your draws, contingencies, collateral, interest caps, extensions, cash control, loans additional if you need it. So the banks are the next kind of key person over here. Brokers, some support, some equity partners. But why am I outlining the sponsor and the bank over here? You got to make sure when you underwrite a project, when you think about the future of the projects, you want to make sure that the sponsor has a direct and clear and trustful communication with your bank, that the sponsor inside has a very well-designed structure, and it's very favorable if he's vertically integrated, meaning that he has his own general contractor, he has its own property management company, it has its own warehouses with a bunch of supplies, it controls the marketing, it controls the demand leads, and so on and so forth. We're going to see in the next slides why understanding that is super crucial, because any underwriting you do on a paper means absolutely zero in case the sponsor doesn't execute it. I would say in case someone does not execute it. And that's why we put a lot of effort in underwriting the sponsor per se. We have a sponsor underwriting matrix actually that we value the relationship. Tempo values the relationship. We go there, we meet with these people, we spend some time with them, we sit in their office, we look at their warehouses, we see if the track record that they have is real, it's not inflated.
So what you're saying is this bubble represents the size of the importance of the player.
Yeah.
Okay.
Absolutely. Now we gotta think about the valuation. When the project is good, fundamentally everything is okay, the sponsor is presumably fine. We got to do some numbers over here. And in this particular case, I'm just giving you an example. It's made up example just to make it all clear. So the numbers are pretty simple. And by the way, you see in this case, I'm putting mass debt in front of pref equity, which might not be the case as we saw from my previous slide. It might be behind pref equity. But let me just introduce you to some terminology over here. So the safe zone, that's the main thing that I want you to think about over here. The safe zone is when the valuation is 94 million, your senior debt and your mezz debt right now in the safe zone, because altogether then they are 94 million and valuation is 94. Of course, I made it like sharp enough just to you to understand the example. It's super cool if the valuation is higher. If it's 120 million, and that means that you have more cushion in front of you. Why is that important? Because when you give you money, you want to make sure that an existing valuation is quite enough to cover your debt in case everything goes wrong. Meaning that if the project is supposed to be sold tomorrow, You want to make sure that your money are within the safe zone, that the existing valuation covers that. We use a benchmark of valuation over here, but we also work with many brokers. And when we underwrite the projects, we heavily rely on the broker opinion of value, BOVs, because we think the brokers are more forward-looking versus backwards-looking, and they have to comply with their words. If they say it's, okay, most likely it's going to be 110 million, then they understand that your next call could be, okay, sell it for this money. So in this case, you see that preferred equity and common equity are not in the safe zone. But again, we're talking about this sample, about this case from the mass debt lender perspective. Now we're good. But it could be the other case, actually. It could be the other case when you look at the project and you see that, let's say, again, I made up the numbers, that the valuation is 74 million. And in order to be in a safe zone, the project should be 94 million. Of course, it's a bit artificial, and you might say, hey, if the valuation is lower than the senior debt, I mean, the bank would probably, take control over it. Of course, you're right. I'm just making it up so that you can understand the general movements of parts. It could be that the project is not enough in value to cover your money. And what should we do in case we sincerely believe that the project is fundamentally good, but we got to solve this problem of $20 million gap in valuation? So what's the logic in here? How can we think about it? How can we still do the project and mitigate this risk? And how do we think? We think about it this way. What if the valuation gap is $20 million? Again, it's made up simple. First step we got to do is let's convert the gap into additional NOI needed. Because as you know, all multifamily projects are valued from their net operating income. The more net operating income they have, the more value they have. And let's assume that their average occupancy in the project is 90% in this area, NOI margin is 65%, and cap rate is 6%. What is occupancy? No. What is NOI margin? Meaning that how much of your NOI is staying with you and how much do you spend for your overall expenses? Normally, it could be from 50 to 65%. Again, I'm taking 65 just to show you the idea. And let the cap rate be 6%. So first, let's convert 20 million using the cap rate into the NOI after your margin and after your occupancy loss needed. It's going to be 1.2 million. Simple math here. Then let's add those expenses on the top that you're going to give. And we divide it by 65%, and we see 1.85 million over here. Then we convert that using some loss in occupancy, and we need additional 2.1 million over here. Again, some people use another coefficients over here. Some people throw some additional revenue and say, hey, it's got to be less, it's got to be more. That's the logic. Just think about it this way. And since we know that we need additional NOI of 2.1 million, let's try to convert it into the actual units rented. We see, let's assume that the average rent is 2.4K months, 28.8K a year. So we divide 2.1 million for this number, and we see that we're going to need an additional occupancy of 72 units to cover all those things. So we need 72 units to be rented to reach the safety zone. Now we have to answer the question, is it possible? Is it feasible? Can they do that? Can they get over there? And we're going to use two different approaches over here. I see some chats are popping up. Nice. Okay. And we're going to do two approaches over here. We're going to do top-down and bottom-up approach. First, let's try to answer the question. How many months would it take to rent an additional 72 units, assuming we have 250 leads monthly? Here, I have to introduce you the concept of leads and demand conversion into the real contracts on the property. Everything is plain vanilla simple these days. Property is acquiring a bunch of leads from apartments.com, from walk-ins, from word of mouth, from whatever you name it, from Google. And normally they convert leads into showings, they convert showings into applications, and they convert applications into contracts. Here you see the national average numbers. It fluctuates from project to project, but we can think about it this way. And why a property management is super crucial to reach those numbers? Because if they do, let's say 40% out of 100 for showings, they are not converting it enough. If they convert, contracts like 5% of total, that's a significant loss because each lead costs you money. But that's the logic, so let's think about it furthermore. Again, the question is, how many months would it take to rent an additional 72 units to get that additional 2.1 million in NOI and then convert it to $20 million revenue to be in the safe zone? It's pretty simple. 250, we divide by 10%, we see 20, multiply 10%, we see 25 units that we're getting right now. But we have some move outs. Let's say we have 20 move outs. So we're going to get 5 units monthly. Additionally, that's 5 units every month are going to be added to our rental pool. And since we need 70 units, we're going to need 14.4 months to get into the safety zone. Wow, that's a lot. So can we tolerate that? What do we do about it? Let's answer another question. But let's say if we want to take approach and answer the question, we need just 6 months actually to do that. And it's fairly simple. Let's do the reverse calculations here. 72 units, 6 months, 12 contracts a month. Plus, we still have those 20 move-outs, 32 contracts a month. That's what we need. National conversion rate gives us 320 leads a month. So as is, we have 14.4 months, 6 months needed to rent those additional 70 units. And as is, 250 leads, but we need 320 leads to rent it for 6 months. We can talk more over here. Is it possible? Is it feasible? Can they get more leads from the market? Can they increase their conversion funnel rates? But all those are the questions to the sponsor that we are exploring on a very careful basis. Again, the sponsor is going to tell you anything he wants to tell you. What matters is the reality in the real life and how can they execute it. So the better you know the sponsor, the more you know the way he works, the more historical data on the sponsor we have, the more trust, the more control we might gain over here. Another question that we got to ask the sponsor is, okay, hey buddy, you're gonna need 12 more units a month to add to your rental pool. And it could be the case that everything is renovated, which is very unlikely. But let's say here you have like total units, you have rentable units, meaning that some of your units are under renovation. Out of your rentable units, you have rented and ready to be leased. This is a nice cushion. The leasing office can work on that. And let's say they have like 50 more, couple months you have before you got to deliver something from your renovation process. But after that, they got to deliver you like 12 units a month to make up those 72 units within 6 months, basically. And the question is, can you do that, Mr. Sponsor? How many employees do you have? Do you have money? Do you have supplies? Let's try to track those numbers. Let's start to see what's going on. So coming back to the picture that I showed you before, that's why the sponsor is a super crucial component over here at this point, because a lot of promises, a lot of execution is over there in his possession. That's why we choose our partners very carefully. After I basically, in general, explain you how do we think about it, we're going to get to a little case study over here, but let me just draw the line. So an existing market has a lot of projects that are vulnerable. We got to be professional enough to choose good projects with good foundational characteristics, the way they were bought, their location, their leasing profile, managed by good sponsors, and having a good demand for the future that are just struggling purely from those financial consequences. Help them and make sure that our help is in a safe zone. And if not, to do something and evaluate what it takes. What does it take to get to the safe zone and evaluate if it's possible, if it's feasible. And I'm going to build a little more on that. So, but let me just quickly jump into this particular case. It's a Riverbend, the project that we like a lot. It's a high-value mass debt investment in Indianapolis. Well, it's a 996 unit multifamily complex. Coincidentally, I made some numbers very similar to the one you have over here. And the example is going to be simple for you. It has a very good growth. It's a semi-stabilized project. They increased their rents from 736 to 1,263 per unit months. They have good returns, very experienced sponsor, Paper Pike, 1.5 billion portfolio and a proven track record. It has a very cool location. I personally was there twice. I like it. It has like Apple Store in front, a bunch of supermarkets, national brands, you name it. You just walk out from there and you can enjoy life. And in general, the project is very well looking. So we got to evaluate if it's a good it's a good investment for 2024. We think it's good. It's low risk and high reward returns. So here is a little narrative. You can read it. They need 7 million of mezz debt to do some minor improvements, extension fees, renewal of rate cap, as I mentioned, and that's why they need money. They will have a term of 36 months, but they hope to repay it for the 17th. It aligns with the Tempo Advantage Fund strategy, finding good projects with good sponsors, suffering purely from financial problems, and do some capital injection, help them to survive, and reap the benefits. Let's look at their numbers right now, where we are. You see, in this particular case, it has a senior debt, it has preferred equity, and has mezz debt. That's what they're asking for. In this case, the mezz debt is number 3. It goes after preferred equity. So the amount of those 3 debts is 120 million right now. They have some common equity over there as well, but from the perspective of a mezz debt lender, we worry about your particular mezz debt as of now. So what is the value? The last one that we saw was about 160 million offered. That's probably a very good benchmark when someone offers you money to buy you out. They rejected it because they believe there is some additional value that could be created. And in this case, the mezz debt is covered with a huge cushion up front. So let's say if the overall value of debt is 120 million, the buyer offered them 160 million. That was not a long time ago. To be on a safe side, we're still, getting some BOVs and some appraisals just to double check what's going on there on their perspective. But in general, everything is fine. But to use the logic that we used before, let's say we still need an additional value of 15 million in the project. That's probably what the sponsor was fighting for when he rejected this offer in 160. They said, hey, I can make more. Again, we're going to use the same logic that we used before. We take some numbers that they haven't placed, 90% occupancy, NOI margin, in their case, average NOI margin is 56%. The cap rate is 6.3, it's higher. I'm not going to run through all this math again. You can double check it later. But at the end, they're going to need additional 126 units to be rented to add additional 15 million of the value. That's about 12.7 increase in their occupancy. They're on an 80% level right now, so they need to occupy to 93.7 because they're 81 actually. And that's going to give them additional 15 million of value. Now, maybe more because they can slightly increase the prices afterwards. But if they're fighting for this, that's probably what they're doing. Let's still answer the question, what does it take to get additional 126 units rented? It's easy, 126 by 12 months, because that's the reasonable horizon that we might use in here. They take the loan for 36 months, but they hope to repay it for 17 months. During 17 months, we take 12. So it's 11 contract months, plus they have an average 40 move-outs. So they need to have 51 contract months to cover the move-outs and add additional 11 contracts a month to their rental pool, which gives them 510 leads a month needed to convert them into those 551 contract. They have right now 400 leads. That's historical data, we have it. But they need 510 leads. That's about 27% increase in leads. Sounds to be pretty big, but let's answer a question. How many additional leads a day do they need? Not much, like about 400 units a day, 4 leads a day. On a scale, when you have like 400 leads a month, 4 leads a day, it's a reasonable amount. So we think they will get there as long as they get some mezz debt money, do some injections into capital injections in the interior, and get with the occupancy where they are supposed to be. So still some problems over here. Still, we got to do something to mitigate the risk. Still, we need to understand how do we deploy capital versus the fact that sometimes the project is not in the safe zone. So normally we would do it very gradually. We would give them a little, make sure they create the value. We would give them a little, make sure they create the value. We would basically deploy the money versus their NOI creation milestones, direct or indirect. Like, would it be occupancy? Would it be a number of units rented? Would it be a number of units, renovated? We got to track that. We not give them all the money up front. Give them a little, they improve. Give them a little, and improve. We also make sure that they invest those funds purely into real estate during the time when they're still not in a safe zone. As long as they get from there, they can use the funds to repay the debt. They can use it to cover some expenses, so on. But on the first period, they have to invest it directly into real estate. So the risk center is normally within the sponsor possession. That's a construction. This is the supply chain. This is the property management, and this is demand creation. So we need to track all those things, and that's why we require direct access to their databases right now. Read only. They give us the full picture: how many leads a day, what was rented, what's going on. So do they create enough value these days to have enough overall valuation to cover my debt? Financial discipline always in there. We got to do expense control that I spoke about a little bit. So we got to draw the money gradually, the NOI creation milestones. Sometimes, the conversation pops up that they have to provide additional collateral when the, gap is super big. An investor want to say, hey, that's too much. We might talk about it as well, but so far we haven't seen that. And, we preach the hands-on approach. We monthly visit the property. I personally do it sometimes. I went to Indianapolis, Detroit, St. Louis, and in other places where we have to go and see what's going on. Talk to people, talk to property management, do the walk-in inspections. We also speak with the brokers directly and say, hey, what's going on in the market? Is it possible that it can sell it tomorrow? What is the price? Can you justify a BOV? We'll look at competitors. But again, we still need to answer the question, and what if not? What if something happens? What if sponsor goes belly up? What if he decides not to do that? We must understand what is the plan B in case something goes wrong. That's why we want to be very, very hands-on, knowing the people in places and what's going on in this particular situation. So that's probably the big picture, I'd say. And just to explain to you again where we were, we spoke about the challenges on the multifamily market right now. We spoke about the place for mass debt financing. We spoke about the value creation and what components of value. We spoke about key players who actually make it all happen. We spoke about valuation from different angles. We spoke about components of that, about safe zone. How can you convert gaps into real money through the rents, of course. And we spoke about what can we do as capital partners to help our investors feel confident and really drive the business forward. I hope you liked it. Should you have any questions, I'm really open to that. So please.
Yeah, we're going to open up for questions now. Real quick, how do you hedge on cap rates softening in the future?
How do we hedge on cap rates softening in the future?
Yes.
Well, if the cap rate in the market, you mean jumps from 6.3 to 5, it only benefits the project if I'm addressing the right question. If the market cap rate goes lower, the project benefits, the valuation goes higher. If you are saying about what if it's going to be even higher than it is right now, let's say it's not going to be 6.3, but 7%. Well, normally the good sponsors like Pepper Pike, they actually initially, when they were buying those projects, when the cap rates were like 3% on the market and 4%, they were underwriting it the way that they would sell it for 6.5%. That's about the purchase component. Remember this we spoke about. And the purchase component is crucial over here because that leaves you some space for unexpected errors or unexpected events like the Fed rate or like a cap rate, jumps back and forth. So that's the case. You just have to make sure that the project complies with all those things. We also do the sensitivity analysis. We kind of ask ourselves a question: what if? And that what if, relates to occupancy, relates to price increase, relates to price drops, relates to cap rates. At the end of the day, it, as an outcome, has a value. Valuation as an outcome that you are tolerant with as a capital partner. And if you say, okay, assuming all the risk I have in place, that's probably the most kind of reasonable valuation. And let's take it from there. Is it enough? Is it not enough? And so on, everything I explained to you before.
Okay, let me play this video real quick for you, and then we'll dive into some more questions. So everyone who is wanting their questions answered, go ahead and put it in the chat, or raise your hand and I will let you speak. But again, if you want to attend the panelist discussion, this is going to be hosted on Friday at 12 as a lunch and learn. And we're going to have multiple sponsors on the call discussing what they're seeing in the market with multifamily, storage, industrial, and retail, all different kinds of asset classes, and how they're handling the changes across the United States. So please register at tempofunding.com/REI. Carve out probably an hour and a half because there's a lot of sponsors on this call. We've got an hour scheduled, but we want to open it up for questions, and so that everybody can get a better understanding of what's happening and the economic impact. Again, we're doing dinners, so this week, San Diego, March 5th, and Boca Raton, March 7th. We would love to have you. Please register. If you need the registration link, email me or schedule a call with me, and I'll be happy to provide that for you. We do have the Tempo Advantage Fund coming out soon. We talked a little bit about it today, and we're working on getting the legal documents finalized this week. A lot of progress has been made. But we wanted to share with you a little bit of detail about it. We expect the target annual returns to be around 16 to 18%, 8% preferred return annually. It'll be an 80-20 split with the upside, and distributions are expected to be quarterly. It's a closed-ended fund, anticipated 5 to 7 years. That's the safe end of it, but we're going to go on a tour of the projects, and we'd love to see you come to join us in Indianapolis and have you get to see the projects that are going to be in the fund. Here's a video about it. Sorry, can you hear that noise? There's a music that should be playing. All right, I'm going to open it up for any more questions. Mike, I saw you joined us during this discussion. Is there anything you would like to talk about?
Sure. So I was going to add a couple of comments on the cap rates. My apologies, just still getting over the cold, so I'm coughing. I'll mute myself. So Misha did a great job answering the question, and it's still a possibility for the cap rates to expand, even though the interest rates appear to have peaked. Something really important to understand. So what Fed did is they pushed the rates aggressively up fast and furious, and the cap rate's taking time to adjust. So it's possible that the cap rates can still expand beyond this point, although from the interest rates perspective, the interest rates have only really one place to go, and it's down. That's been pretty clear. So how fast Fed will ease is still unknown. They may go slow. So there's some risk of cap rates expansion. So as Misha pointed out, part of the analysis is sensitivity analysis and projects some cap rate expansion relative to what it is today. But the big difficulty is what are the cap rates today? And it's unclear and unknown. The transaction volume has been very soft and slow. So with few transactions taking place, and typically these transactions being somewhat distressed, it's a little bit of a difficult time to evaluate where the cap rates are going to be. This is part of the difficulty. So some assumptions need to be made, and really these assumptions hover around where the interest rates will settle on a long-term basis in, say, a year or two from now. There is a forward curve that can be used to see what are the projections of where the interest rates may be based on what the market sees. There's another way to look at things is to look at, will the Fed be able to get inflation under control? And if they do, get inflation under control, and data is pointing out that they are moving in that direction, then the long-term interest rates should come down. This is the general thesis. Why? Because they're at a very, very restrictive level. So in the normal circumstances, 10-year Treasury yield should not be 2.5% or 2% higher than the rate of inflation. It should be way, way closer, 0.5%, maybe 1%. So that's the general economic theory. As far as where the market will settle, it depends on the level of distress, level of opportunities, market dislocations. But on a long-term basis, quality of assets will matter too. So another very, very important consideration is not generally cap rates as a group, but what happens in a given market with a certain type of properties. So in traditional quality, larger properties, some of the larger assets, like example of Riverbend, 1,000 doors, great asset, sort of a priced asset in market like Indy, we believe it's in a better position versus some of the Class C properties in more volatile areas. So the answer to the question is not a trivial answer, but most definitely all real estate is local, and cap rates will depend on type of assets and depend on type of location. And so there's going to be some volatility and variance in where the cap rates will settle. How can you hedge? Well, there's no easy way to hedge. You can buy some kind of insurance contract. You can buy a rate cap, basically a policy of sorts to protect against that. But the rate caps are expensive now. So there's no easy and trivial way. You can do some financial speculation. But part of analysis, of course, you can assume some cap rate expansion. You could also look at keeping the cap rates where they are now, which is, as I said, very based on a very low transaction volume. Or you can go back and say, hey, look at where the interest rates should settle, and then make some assumptions there. So it's a fundamental question. It's a great question, just no easy answer. And overall, you got to give the market a little more time to settle in. And there's also a lot of capital sitting on sidelines, all looking for phenomenal deals. When that money flows in, it can actually move the cap rates down from the point of view that lots of dollars chasing deals. So it's going to be fluid and dynamic over the next year or two, when we'll see where we wind up. That's the best way to look at this. But from a mezz perspective, we're looking at the deals that have some kind of margin of safety, that have great sponsors, that have opportunities where we feel that kind of even in the conservative case scenario, we should do okay from a mezz perspective. That's the general thesis behind that whole discussion.
I want to bring up this graphic that we put an article out on about almost, I guess it was last summer, Q2 of 2023. And we updated, we discussed this. And Misha, what's your perspective on this?
Yeah, I mean, speaking about multifamily, I think we're pretty much there. With the only thing is that we're not going to see super many distressed properties like in 2008 because, you know, a lot of properties still survive. They had some nice cash reserves. They raised more money in advance. They're doing some capital calls. They're good in their nature. So the level of distress is not going to be as high as in 2008. We're still going to see a lot of opportunities, and majority of them will come from banks, I'd say, because banks are going to be the first one who see the distress to the level when it's available to the market players. I'd say the banks are going to build a lot of trust with the existing sponsors who are willing to take the projects and bring it to another level. Because first time there is a stress to the asset, that's okay. If you do it another time, I mean, from the bank perspective, they're going to fire the manager. So they want to make sure that they give it to proper people. And on the other hand, there are so few good sponsors in the market, and still going to be a lot of distressed property that I think big players are going to jump into, like BlackRock. They're going to, you know, buy some distressed stuff just as is, wait a little bit, and sell it when the market will start to recover. So I think there is a lot of wealth transferring right now in 2024, 25. And as capital partners, we gotta be understanding who is the good sponsor, who can take it from point A to point B and survive in these hard times. That's my perspective on that. Speaking about offices, self-storage, industrial, residential, it's a long conversation. And I would say they're not there yet at all. Maybe about offices that are like struggling extremely right now, especially when you look at like San Francisco, for example, and they sell those offices like for 25 cents a dollar from their construction value. So, so that's where we are right now with multifamily. It's a good time. We just got to play with good players.
Yeah, there's a lot of different conflicting articles out there, and it gets a little confusing, especially, you know, you can't just do a blanket statement about the entire United States. It is definitely
Of course.
local, because I know they're still building office in certain sector or in certain areas of the country, and multifamily is doing great in certain areas. But others, you know, rents are decreasing. And so what are we starting to see play out with the banks? Are the banks doing anything aggressive? Is there any update on that?
I don't see it in my end. I mean, I don't have enough information to talk confident about it, but what we see is that the banks are not in a rush to get those projects under their roof. They kind of don't want to have it. They would do probably much to save them, but also they still want to reap some benefits from it. So it's like, you know, they're balancing right now. So it's not like, again, in 2008 when the banks just, you know, grabbed it all for whatever reason it was. Now they're like, okay, that's an asset that we still have to do something with. We got to find somebody who will take it from point A to point B, who will work on it. And we don't have enough time for that. We're banks, you know, this is something different that we have to do. We don't want to do that. So they would prefer them to be saved, but some of them effectively would just get into their possession.
I speak with a lot of investors that kind of held off on the last several years because they thought it was too good to be true. What is, I guess, what is your outlook on this year for investing? Mike or Misha, whoever wants to answer that one.
I'll add one comment on the banks and what's happening. Again, it's work in progress, right? So interest rates higher for longer, causing grief to obviously investors and also banks. And it takes time for the problems to show up in the system. So this morning I was reading an article that the New York Community Bank, which is one of the large regional lenders here in New York City, that works with real estate. And they had pretty bad earnings. The stock dropped, the CEO resigned, which is not necessarily good news at all. So, but the cracks in the eyes are beginning to show in the banking system for the banks that have exposure to office and multifamily and some other commercial real estate sectors. Again, it's unclear what the ultimate outcome is going to be, but what is clear is that the higher for longer are going to continue to cause issues for the commercial real estate space. So I just wanted to state that. As far as where the outlook is, well, challenges and difficulties create opportunities. It's as simple as that. So, and I hate to put it, in real estate, kind of one person's problem is another person's opportunity. So as even good sponsors, good operators, get hit with a tidal wave that hit not just one property that they own, but a whole bunch of them. The interest rates affect the industry. They don't affect one region or one town or one area. So that pressure is mounting, and it's creating opportunities. And there are projects that are still worthy, that are still have long-term good chances of success. They just need more liquidity, and this is where the opportunities become available. You don't need to wait for the bank to foreclose the property and try to buy it as a bank REO. That concept, buying as a bank REO at a steep discount, is still a great concept. It makes a lot of sense, but it's going to take a way longer. The bank's going to have problems. They're going to have to foreclose these assets, take them, and then try to sell them as an REO property. There are plenty of other deals that you can get into today without waiting for the assets to go into the bank possession. And that's where we see the mezz debt and the mezz financing opportunities to come in, because it pushes back the capital stack, all the previous money. And it's unfortunate for the previous dollars invested, but without the cash infusion, these projects just can't survive, or the chances of survival are very low. So we see immediate opportunities in that space. So for 2024, over the upcoming months and quarters, the mezz debt plays a really big opportunity. I spoke with other sponsors, operators, capital partners, folks who raise capital and deploy capital and use capital, and everybody's gearing up for that. This is where the dollar's going to flow with the worthy sponsors on the worthy projects in the right location. While the REO foreclosed deep distressed property concept is still in play, under some circumstances, some assets will flow that way, but it may be probably later part of this year and into the next year. But for the dollars coming in later this year, mezz debt is really, or mezz equity or mezz financing is the only play that I see happening in any meaningful volume, as those opportunities are a lot more immediate. One of the questions that can come is it a dropping knife? Can these properties still continue to fall in value? Can there be more concerns? Of course they can be. And that's why careful evaluation, careful underwriting is required. There are properties that still have deep enough, let's call them equity rich, cash poor. Example, we talked about this is Riverbend. So that project has enough equity cushion behind, but it still needs liquidity. Projects like that present really, really good opportunity to come in. And even if the price corrects another 10% or another 15%, there's still room for the mezz debt to do just fine. So that's the process, and that's what the opportunity. You could sit in your hands and wait for the assets that are distressed and for the banks to foreclose. But these opportunities might not even be easily available, and they may be sold in bulk to the big shops like Blackstone's, and it's unclear how the whole thing will flow. It's not even clear whether the banks will try to foreclose on them or do some workouts with borrowers. A lot of these conversations are still very, they're happening, but where they're going to wind up is unknown. But what is known for the rest of 2024 is a mezz financing is an area of opportunity. That's pretty clear.
Well, thanks for sharing. If there's anyone else with any questions you need answered, don't hesitate to reach out. But thank you for attending this Lunch and Learn, and we hope to see you on March 22nd at the panelist discussion. Thanks, everyone.
Thank you so much, and bon appetit, since it was Lunch and Learn.
Thank you.
Yeah, take care.